All right, here we're going to be looking at a determination and distribution schedule that's used in the consolidation process between the parent company and the subsidiary. The parent buys the subsidiary and they have to issue consolidated financial statements. And this distribution schedule here is used to determine the adjustments that have to be made to the subsidiary's accounts in this consolidation process, and we're going to be looking at it in terms of the worksheet process here for this consolidation and how this distribution schedule is integrated with the worksheet here for the consolidation. So the distribution schedule here first would have the fair value of the subsidiary, and then we'd have to subtract out the total equity here at the book value for the subsidiary. So going up to the balance sheet here for the subsidiary, that would be its book value here for its equity. That would be the common stock, also any additional paid in capital, and then the retained earnings. So going back down to our distribution schedule here, we'd have to determine the excess of the fair value over the book value, and that's really the difference between the fair value of the subsidiary less this total equity amount here. That would get our fair value over the book value here, the excess. But we can also go up here and look at it in terms of the balance sheet here for the subsidiary, and that's really also the difference here between the book value and the fair value for the assets and liabilities here based on the subsidiary's balance sheet here. And for our example here, I'm only looking at one amount here, and that would be where the fixed assets increased here from 240 to 300,000, and that would be a building increased in that amount for $60,000 here. So going back down to our distribution schedule, that excess of the fair value over the book value here for the balance sheet for the subsidiary in this case would be $60,000. And of course all these amounts here are proportioned out between the parent and the non-controlling interest. Okay, looking at the consolidation worksheet. Before we get into our adjustments using the distribution schedule, we first have to adjust our investment account here in the subsidiary because it has a 12/31 or end of the year date here, and the equity accounts for the subsidiary here are at the beginning of the year, a 1/1 date. So we have to adjust this investment in the subsidiary back to the beginning of the year, 1/1 date. So looking at our investment account here in the subsidiary, we would receive $54,000 in income, or the parent did, from the subsidiary here. So we have, and that would have been debited to this investment account. So we have to adjust our consolidation worksheet here by crediting this income earned here for $54,000, and then the balancing amount here would go to debit the subsidiary income here on the worksheet here. And then we also had $18,000 here in dividend declared from the subsidiary, so that would have been accredited here to the investment in the sub for $18,000. So we have to make an adjustment here on the worksheet by debiting the $18,000 here for the dividend declared, and then the balancing amount would go to credit $18,000 here on the worksheet. So now, after adjusting our investment account here back to the beginning of the year, we can go in and make our other adjustments off the distribution worksheet. All right, our other adjustments here are going to come off our distribution schedule. So for our distribution schedule, the fair value of the sub we had at $300,000 here. So the parent got 90% of that, or $270,000. Non-controlling interest was $30,000. Then we have to subtract out the equity here for the subsidiary. So its common stock was $100,000, retained earnings $140,000, total equity was $240,000. So the parent would get 90% of that. So they'd end up here with $16,000 here for the book value here of the equity here. And then the non-controlling interest, they would have got 10% of the $240,000, or they'd end up with $24,000 here for the book value here of the equity. So looking at the difference here to determine excess of the fair value over the book value, we just take our total equity here assigned, subtract that from the fair value of the subsidiary, in this case $300,000 less $240,000. We get a total excess of the fair value over the book value here for $60,000. And then the parent's portion would be 90% of that, or $270,000 less the book value here of $260,000 gives us excess here of $54,000. And the non-controlling interest would just be the would be 10% of that here. 24,000. Subtract that from its fair value of 30,000. We end up with 6,000 here for the excess. All right, to make our elimination and our adjustment entries, the first thing we have to do is we have to eliminate 90% here of the sub's equity against the investment account. So looking at the parent's equity here in the sub, 90% of the common stock here of 100,000 gives us 90,000 here, and then the retained earnings 140,000, 90% of that gives us $126,000. So the total amount that we have to adjust here is $216,000. So we'd go up here through the investment in the subs account here, we'd credit that for $216,000, and then the balancing entries here would be to the common stock here for the Corporation S for $90,000, and then the retained earnings amount here for $126,000. Okay, next we have to distribute this excess investment here. So for simplicity purposes, the $60,000 total amount here, that was just assigned to a building that increased in value by $60,000 for the year, and we're depreciating that at $6,000 per year here. So first, the $60,000 amount here, that would go to the building. Here we debit or increase our building for $60,000, and then the $54,000 here for the parent's 90% interest, that would be to credit or reduce the investment here in the sub by $54,000, and then the remaining $6,000 here for the non-controlling interest here, that would go to increase the retained earnings here for the sub by $6,000, or credit that amount here. And then we just have to deal with the depreciation here of the building. So we have $6,000 here that would credit or reduce the building for the sub, or for the year here of $6,000, and then the building depreciation expense here would be debited here for $6,000. Okay, in summary, when using our determination and distribution schedule here for our consolidation worksheet adjustments, the first thing we have to do is we have to eliminate the parent's portion of the subsidiary's equity account here. That would be their common stock and their retained earnings. And then the next thing we have to do is we have to account for this excess of the fair value over the book value. That was the difference between the fair value of the subsidiary and then its total equity account here at its book value. And going up to our balance sheet, what that would be accounting for here is the difference between the book value and the fair value for our asset and liability account. So if we had an increase between the book value and the fair value for a particular account, we'd have to increase that account, and then if we had a decrease between the book value and the fair value, we'd have to adjust that account down. So after we make all our adjustments here between the book value here and the fair value on our consolidation worksheet, then we have to account for the distribution here, going back to our distribution schedule between the parent's amount here and the non-controlling interest. And those would have to go onto our worksheet as well.